This is Matt Godleski with CapTrust Advisors bringing you this week's snapshot edition of The Pulse. Here's what we're watching this week. Stocks pull back on Fed predictions as economic data softens and the bond markets signal weakening growth and inflation. Equity markets retreated this week, though they remain near all-time highs. All eyes were on the Federal Reserve, which surprised investors by updating its forecast. Higher rates than originally anticipated were signaled for the years ahead. Jobless claims increased last week, an unexpected break in the trend of Americans getting back to work. Retail sales also fell more than forecast in May, though this likely suggests consumers are shifting their purchases from goods to services as they spend more on travel and entertainment. In a sign of strength, corporate America has boosted its cash holdings by 12% since last year, seeking to be better positioned for uncertainty ahead and ready to fund acquisitions or introduce new revenue streams. In terms of market valuations, despite a rapid rise in stock prices over the past year, record profits have brought most of the largest U.S. companies' share prices in line with their 5-year historic averages. The Federal Reserve's guidance took many by surprise, suggesting that interest rates may rise by half a percentage point by the end of 2023. The more aggressive posture was updated due to uncertainty around inflation, which many had suggested the Fed was already behind on recognizing. At the same time, Fed Chair Jerome Powell reiterated the Fed's belief that the recent surge in inflation would be transitory. Indeed, certain commodities and prices have already begun to cool, with lumber dropping 40% since its peak in May. Corn, soybeans, copper, and even housing are starting to cool off as well. As the Fed suggested, supply bottlenecks from the COVID-19 shutdown are likely the true cause of recent inflation spikes and should return to more normal levels as production ramps back up. These signals provide confidence that the Fed knows what it's doing and that its wait-and-see approach is prudent. At the same time, the Fed's commitment to full employment and financial stability explains its ongoing bond purchases and enormous balance sheet. At present, we are making no changes to portfolios as we feel well positioned for the current environment. Stocks and bond markets appear stable based on improving economic fundamentals. Also, inflation should likely be contained through thoughtful Federal Reserve action. We remain overweight stocks versus bonds, and we've increased our cash allocation. We prefer to have liquidity to provide funding for purchases should volatility pick up in coming months. We find stocks in Europe more favorable with the vaccine rollout there gaining pace and economic growth ticking up. Furthermore, European companies are generally more exposed to cyclical and value sectors, which we continue to believe will outperform in the coming months. As always, we remain focused on changing market dynamics and making updates only when appropriate. Thanks for watching.